Good morning, children. This is session 3 of Fundamentals of Partnership Accounting. We did the preparation of profit and loss appropriation account in the previous session. Now I am introducing the concept of fixed and fluctuating capital accounts. A fluctuating capital account is an account which basically permits the change in the balance every year. Means we carry some balance, then we make some adjustments within that account, and then afterwards we carry a different amount to the next year. So every year amount of capital changes in the partner's capital account. That's why it is called fluctuating capital account. It is like a regular capital account which we use to prepare, right? And just see how it is being prepared. On the credit side, we put balance brought down, that is opening balance. Bank account. If any fresh capital is introduced by the partner, then that will be written. Then salaries, interest on capital, and profit and loss appropriation account. This will be only the share of divisible profit. All plus items are coming on the credit side. Now all minus items, that means the items which are going to reduce the amount of capital, will be shown on the debit side. You all know drawings is a deduction in capital, so it will be shown on the debit side. Interest on drawings also will be deducted from partner's capital account, so it will also be shown on the debit side. Then profit and loss account, if there is divisible loss, then profit and loss appropriation account, that will be deducted. Then finally the balance carried down. So it is a regular account which we are showing here. Regular capital account as we used to prepare for a sole proprietor. No difference in that. Now we have to introduce the concept of fixed capital account system. Under fixed capital account system, children, we do not permit the original amount invested by the partner in the partnership firm to be altered except in two exceptional cases. First, additional capital introduced by the partner. Second, permanent withdrawal of capital by the partner. These are the two exceptional cases. Otherwise, year after year, the amount of capital remains same. The balance of capital remains same, so that very easily we can find out what was the original investment made by the partner in the partnership firm without any alteration. Just see this. Partner capital account in this case will carry balance brought down on the credit side, balance carried down on the debit side. So it can remain same for many years. Only in the case when fresh capital is introduced by the partner, or when there is permanent withdrawal of capital by the partner, which comes on the debit side, the amount of fixed capital can change. Otherwise it will remain fixed for years together, right? So it carries only the balance brought down, balance carried down. Basically other two items are very rare, we rarely find. So where will all the adjustments go? Adjustment like interest on capital, salary, commission, where will they go? For them we'll be preparing a separate account for the partners, which will be called partners current account. All adjustments will be shown here. Now this account also can have balance brought down on either of the side. In case of capital account, we have balance on credit side. But in case of current account, we can have balance brought down either on the debit side or on the credit side. Have you noticed? Because after adjustments, there can be negative balance, there can be positive balance as well, right? Then all the plus items as usual on the credit side, like we have done salary, commission, interest on capital, profit and loss appropriation account, the share of profit, right? Then on the debit side, we have drawings, interest on drawing, profit and loss appropriation account, whatever is a share of loss. Then after that, balance carried down can come on either of the side. Either of the side means if the debit side is heavier, means the negative items are more than the positive item, then the balance CD will appear on credit side. And otherwise, in all the regular cases, it will appear on debit side as we have in case of capital account. One thing I would like all my children to notice, that if it is distributable loss, we are writing profit and loss account, not profit and loss appropriation account. So this is a point to be noted, that in case firm is having net loss, no appropriation account will be prepared in that case, right? So it will be, the loss will be directly distributed from the profit and loss account itself. Profit and loss appropriation account will not be prepared. No interest on capital will be given. No salary will be given. No commission will be given. So this is a point to be noted here, right? This point I hope is clear to everybody, that profit and loss account, why it is written on the credit side. I hope this is clear. So it is nothing but bifurcation of fluctuating capital account into two parts. First part where we had shown the capital balance, main capital balance, capital invested by the partner. Second part where we show all the adjustments. I hope this is clear. Yes? Okay. Now moving on further, we have to do the difference between fixed and fluctuating capital account. Let me tell you children that this is most important theory question. From theory point of view, it is very, very important. Now, number of accounts. First point. Under fixed capital account system, we prepare two accounts, that is partners capital account and partners current account. Under fluctuating capital account system, we prepare only one account. The main balance plus all the adjustments appear in one account, that is the capital account of the partner. Second, adjustments. In fixed capital account system, all adjustments like drawing salary and all are shown in the current account, not in the capital account. Whereas in case of a fluctuating capital account system, all adjustments regarding drawing salary and all are shown in the capital account itself. Third, fixed balance. In case of a fixed capital account system, the capital account always carry the unaltered amount, the same amount year after year. It can change only in case of additional capital introduced or permanent withdrawal of capital. Then, in case of fluctuating capital account, the capital balance keeps on fluctuating year after year, right? Then, credit balance. If we are preparing fixed capital account, then in that case, the capital account of partner will always show a credit balance, means a positive amount of capital. Whereas in case of a fluctuating capital account system, the capital account may sometimes show the debit balance also. Debit balance means that there can be negative amount also. If there is, the amount of loss is very heavy, then the capital account can show us a debit balance as well. I hope this distinction table is clear, right? So we are moving further. We are moving further now, and we will start with the illustrations. Illustration 1, we'll learn how to prepare all the accounts. Let's read the illustration very carefully. We are partners in a firm sharing profits and losses in the ratio of 2:1. Please underline ratio 2:1. This is important that we should note in which ratio partners are going to distribute their profit and losses. With the capitals of rupees 10 lakh and rupees 5 lakh respectively, and this amount of capital is given in the beginning of the year, that is on 1st April 2018. Each partner is entitled to 8% per annum interest on capital. Means if we calculate 8% interest, A will get 8% of 10 lakh means 80,000, and B will get 8% of 5 lakh means 40,000 by way of interest on capital. B is entitled to a salary of 3,500 rupees 3,500 per month. Please notice it is per month, so you have to multiply it by 12 in order to get the yearly salary. Together with a commission of 10% of net profit remaining after deducting interest on capitals, right? So after deducting interest on capital from net profit, whatever amount will come, 10% of that will be given as commission, but there is a further clause. This is after deducting interest on capital and salary and after charging his commission. So out of net profit, you have to deduct the salary, you have to deduct the interest on capital, then whatever amount you will get, it will be 10 upon 110 of that, which will be paid as commission to the partner, that is B. You remember manager's commission formula? That the same formula we are using here. The profit for the year ended 31st March 2019 prior to the calculation of interest on capital but after charging B's salary. Please carefully note that from this profit B's salary has already been deducted. Were we supposed to deduct the salary? You know that it is not possible. Net profit should be without deducting the salary of B. So we have to now calculate adjusted net profit where B's salary will be added back to it in order to find out the amount of net profit to be transferred to the credit side of partners profit and loss appropriation account. Right? So what is required? Let us see that carefully. They want us to show the division of profit and to prepare partners capital account. Right? These are the points which we have noted. And when the partners capital account to be prepared, first when capitals are fixed and second when capitals are fluctuating. Let us see how we are going to solve this. First we'll be preparing profit and loss appropriation account, right? In profit and loss appropriation account on the credit side, it is by profit and loss account. See here what we have done. See this. It is 4,50,000, the net profit as given in the question. But to this I have added 42,000. What is this 42,000? It is nothing but B's salary, 3,500 multiplied by 12. Added and now it becomes 4,92,000. Right? So this is adjusted NP transferred from profit and loss account to profit and loss appropriation account. Right? Now come on the debit side. So what items will be now shown on the debit side as deduction? It is first item to B's salary 42,000. Salary is provided only to B. Then to interest on capital as we calculated, it was 8% of 10 lakh, 8% of 5 lakh, 80,000, 40,000. In all, final amount transferred is 1,20,000. Then comes to B's commission. B's commission, for that will be seeing the working note. To find out how this has been calculated, the amount is 30,000. Then afterwards, we deducted amount 42,000 plus 1,20,000 plus 30,000 from 4,92,000 to get rupees 3 lakh. It was nothing but distributable profit and which we divided in the ratio of 2:1. 2 lakh to A and 1 lakh to B. I hope this preparation is clear. The only question left in our mind is how we have calculated B's commission. So let's find out how B's commission has been calculated, right? See the notes, working notes, right? Calculation of partners commission. The profit which was given to us was after the deduction of B's salary. Question said that commission to be calculated after the deduction of salary and interest on capital. So out of that 4,50,000, B's salary has already been deducted. So we have to deduct only interest on capital. The total interest on capital was 1,20,000. So we have deducted this. We got the amount of 3,30,000. Now we have to apply the formula as we did in case of manager's commission. So B's commission is equal to 3,30,000 into rate upon 100 plus rate. So 10 by 110. So the final amount comes out to be 30,000. I hope now the calculation is very clear to everybody. Right? Now moving on. It is when the capital accounts are fluctuating, how the capital accounts will be prepared. Right? We started from the credit side, children. As we always start in case of all liabilities on capital account. From the credit side, by balance brought down. This is the opening balance of the capitals 10 lakh, 5 lakh. 10 lakh for A, 5 lakh for B. Now, by partner's salary, you all know partner's salary was provided only to B, not to A. So, that was only in B's account. We are making a simultaneous account of both the partners. That saves our time. So, 42,000 given to B. Then interest on capital was provided to both the partners. 80,000 to A, 40,000 to B. Moving on further, it is commission, partner's commission. Again, it was given only to B. So, only in B's account we are showing it. In A's account, we are showing nil. This is clear? Then the distributable profit. 2 lakh, 1 lakh. right? There were no deductions in the form of drawings or interest on drawings. So we calculated the closing balance 12,80,000 for A, 7,12,000 for B. This much is clear. This is fluctuating capital account. Now we will move on to fixed capital account, where this same account will be divided into two parts. The opening balance will remain in the capital account and all the adjustments will go to the current account of the partners, right? Now see, when the capital accounts are fixed, see the capital account. In partners capital account, only the opening balance is coming. Since there were no drawings, right? Opening balance 10 lakh, 5 lakh, this is coming here, right? And since there were no drawings from the capital, there was no additional capital being introduced. So the same balance we are carrying forward to the next period, right? So in capital account, only the balance. And then all adjustments are going into partners current account. See that carefully. Partner's salary, interest on capital, commission, right? See, and the distributable profit. Children see? Now, to balance carried down, the total here, no deduction. So, 2,80,000 for A, 2,12,000 for B. Now, there may be a possibility that if we are having a big amount of drawings on the debit side, we can have a negative balance also. So, in that case, balance CD will be on the credit side rather than being on debit side here. This is clear how we have prepared these accounts, right? So we are simply transferring the thing. Notice one very important point, children, that we are writing partner's salary, interest on capital and commission. Remember the journal entries, related journal entries which we did? We are using here the first method, not the alternative method, which was partner's salary debit to partner's capital, interest on capital debit to partners capital, commission debit to partners capital, and for distributable profit it was profit and loss appropriation account debit to partners capital account, right? This thing we are following here. So profit and loss appropriation account is coming only for distributable profit. I hope this is clear to all of you. We'll be doing more illustration in the next session today itself. So please don't forget to move on further with session 3 for today and session 4 otherwise for the fundamentals unit. Do that, only then you'll be able to solve the assignment questions which are I am going to put as weekend assignment. Please make a separate copy for assignment, and all this which we are doing here in my sessions will be written in the classwork copy. I hope I have made myself clear. Thank you children, and please don't forget to see session 3 for today for more illustrations.